The iconic Toys R Us, a name synonymous with childhood joy and endless aisles of playthings, once reigned supreme as the world's largest toy retailer. For decades, it was the undisputed champion, a retail giant that seemed impervious to challenge. Yet, the empire ultimately crumbled, vanishing from the American landscape in a stark illustration of modern retail's unforgiving nature. This documentary will dissect the complex interplay of factors that led to its demise, centering on three critical vectors: a crushing burden of debt, relentless competition from both digital and big-box rivals, and fundamental shifts in consumer behavior. Founded by Charles Lazarus in 1948, Toys R Us revolutionized toy sales. Lazarus pioneered a supermarket-style approach, offering an unparalleled selection under one roof, a stark contrast to small, boutique toy shops. This category killer model, as dubbed by retail analysts, allowed Toys R Us to expand rapidly. By the 1970s and 80s, its distinctive branding and overwhelming inventory solidified its position, making it the primary destination for families seeking the latest and most comprehensive toy offerings, from board games to action figures. By the late 1990s, Toys R Us had established a formidable retail empire. It commanded an estimated 25% of the U.S. toy market, a share unmatched by any competitor. Globally, its footprint extended across multiple continents, operating over 1,500 stores worldwide at its peak. This dominance wasn't just about sales volume, it was about cultural penetration. Toys R Us shaped holiday shopping, dictated toy trends, and became an indispensable part of childhood for millions, its jingle instantly recognizable, its aisles a wonderland of discovery for eager young shoppers. Despite its long-standing success, the seeds of Toys R Us' downfall were arguably sown in 2005. That year, a consortium of private equity firms, Bain Capital, KKR, and real estate investment trust Vornado Realty Trust acquired the company in a leveraged buyout valued at approximately $6.6 billion. This was not a traditional purchase funded by cash reserves. A significant portion of this acquisition was financed by debt, which was then transferred onto Toys R Us itself. This strategic financial maneuver would fundamentally alter the company's trajectory, shifting its focus from retail innovation to debt management. To understand the profound impact of this deal, it's crucial to grasp the mechanics of a leveraged buyout. In an LBO, the acquiring firms use a relatively small amount of their own capital and borrow heavily against the assets and projected future earnings of the target company. Crucially, the debt taken on to complete the purchase then becomes the responsibility of the acquired company. For Toys R Us, this meant that from 2005 onward, it was burdened with billions in new debt, severely limiting its financial flexibility and diverting critical resources towards servicing interest payments rather than reinvesting in its core business or adapting to market changes. Quantifying this burden, financial reports indicate that Toys R Us was saddled with approximately $5 billion in debt following the LBO. Crucially, the company was reportedly paying hundreds of millions annually. Some estimates suggest up to $400 million in interest payments alone. This colossal outflow of capital was not directed towards improving the customer experience, upgrading its digital infrastructure, or offering competitive pricing. Instead, it was simply servicing debt, fundamentally undermining any strategic investment required to adapt to a rapidly changing retail landscape, leaving its stores and online presence stagnant. As Toys R Us grappled with its debt, a new force was reshaping the retail world: Amazon. The burgeoning e-commerce giant was rapidly gaining traction, offering unparalleled convenience and, critically, often lower prices. Ironically, Toys R Us had entered a 10-year partnership with Amazon in 2000 to manage its online sales. This agreement, initially seen as forward-thinking, effectively ceded its digital autonomy, preventing the company from developing its own robust e-commerce capabilities. When the partnership soured and ended prematurely in 2006, Toys R Us found itself years behind in the digital race, facing a formidable, self-built Amazon. The competitive landscape wasn't only digital. Brick-and-mortar behemoths like Walmart and Target significantly intensified pressure. These general merchandisers, with their vast purchasing power and diversified product lines, could afford to treat toys as loss leaders, selling them at minimal profit or even a loss to draw customers into their stores, where they would then purchase higher-margin goods. As a specialty retailer solely focused on toys, Toys R Us lacked the strategic flexibility. It couldn't subsidize toy sales with groceries or electronics, leaving it vulnerable to relentless price compression and margin erosion. This multi-front attack on pricing proved devastating. Toys R Us was caught in a squeeze, compelled to match competitors' lower prices to avoid losing sales, but simultaneously unable to absorb the resulting margin erosion due to its heavy debt burden. Reports indicated gross margins suffered significantly, by an estimated 10 to 15% in key product categories over time. Every dollar cut from profit margins meant fewer dollars available for innovation, store maintenance, or debt repayment. This constant tug-of-war between competitive pricing and financial viability ultimately weakened the core business. Beyond direct competition, a seismic shift in consumer behavior fundamentally altered the retail landscape. The internet transformed how families shopped, not just for toys but for everything. Online shopping offered unparalleled convenience, allowing parents to browse, compare prices, read reviews, and purchase from the comfort of their homes, often with free delivery. This shift wasn't merely a preference, it became the norm, eroding the need for dedicated physical toy stores. Consumers gravitated towards platforms that offered boundless choice and instant gratification, a model Toys R Us struggled to replicate. Compounding the digital shift was a broader cultural trend, a growing preference among parents to invest in experiences rather than accumulating physical possessions for their children. Spending shifted towards travel, digital entertainment subscriptions, educational activities, and family outings. While toy sales remained substantial, the rate of growth declined, with physical toy sales seeing an estimated annual decline of around 5% between 2015 and 2017. This evolving mindset meant that even when families bought toys, they often did so as part of a larger general merchandise purchase from a big box store or online, further sidelining the specialty toy retailer. Toys R Us stores increasingly became victims of the showrooming effect. Customers would visit the physical stores to browse the vast selection, examine toys firsthand, and gather product information. However, instead of making a purchase there, they would use their smartphones to compare prices and ultimately buy the same item cheaper online, often from Amazon or from big box retailers like Walmart and Target. This phenomenon turned Toys R Us into an unpaid display space for its competitors, draining sales from its brick-and-mortar locations and undermining their very purpose. Following the contentious split from Amazon in 2006, Toys R Us faced the immense challenge of building its own e-commerce platform from scratch. However, years of underinvestment, a direct consequence of the debt burden, meant it struggled to develop a competitive online presence. Its website often lagged in user experience, inventory management, and fulfillment capabilities compared to digital leaders. While competitors refined their algorithms and logistics, Toys R Us remained perpetually playing catch-up, unable to offer the seamless, efficient online experience that modern consumers had come to expect and demand. The debt also crippled Toys R Us' ability to innovate its physical store experience. While rivals invested in bright, modern, and interactive retail environments, many Toys R Us stores remained dated, cluttered, and uninspiring. The capital that could have funded renovations, in-store play areas, or enhanced customer service was instead funneled into debt payments. This lack of investment meant that even as the digital world offered endless novelty, the physical Toys R Us experience failed to provide a compelling reason for customers to choose it over more contemporary or convenient options, further accelerating its decline. For decades, Toys R Us commanded significant brand loyalty, a special place in the hearts of children and parents alike. It was often the first, and sometimes only, destination for toy purchases. However, as toys became ubiquitous, available everywhere from grocery stores to gas stations, and just a click away online, that loyalty eroded. The unique magic associated with a dedicated toy store diminished. With competitive pricing and unparalleled convenience elsewhere, the emotional connection alone was no longer enough to drive consistent sales, transforming a beloved institution into just another retail option. By September 2017, the cumulative pressures became unbearable. Burdened by billions in debt and facing insurmountable challenges in securing crucial vendor credit ahead of the critical holiday season, Toys R Us filed for Chapter 11 bankruptcy protection in the United States. This move aimed to restructure its massive $5 billion debt load and reorganize operations. Despite attempts at a turnaround, the financial damage was too extensive, and the market shifts too profound. This filing marked the beginning of the end for the American operations of the iconic toy retailer. Despite initial hopes for restructuring, the immense debt and the inability to compete effectively on multiple fronts proved insurmountable. In early 2018, Toys R Us announced the painful decision to liquidate all of its U.S. stores. This meant going out of business sales across hundreds of locations, marking a heartbreaking and definitive end to a retail institution that had defined childhoods for generations. The liquidation resulted in thousands of job losses and left a significant void in the toy market, impacting vendors, landlords, and countless communities across the nation. The contrast between Toys R Us' financial constraints and its competitors' agility is stark. While Toys R Us was spending upwards of $400 million annually on interest payments, rivals like Amazon and Walmart were freely investing similar sums into e-commerce innovation, supply chain efficiencies, and store modernizations. This wasn't merely a difference in scale, it was a fundamental disparity in strategic capability, where one entity was perpetually playing defense against its own balance sheet, while others were aggressively expanding and defining the future of retail. The opportunity cost was immense. Toys R Us, as a specialty retailer, found itself ill-equipped to battle diversified giants. Big box stores leveraged their broad product range to absorb lower toy margins, using them as customer magnets. E-commerce platforms, particularly Amazon, offered an unmatched selection, convenience, and aggressive pricing that a physical-only, debt-laden specialty store could not sustainably counter. The retail landscape had evolved from specialized markets to integrated shopping experiences, where breadth of offering and digital seamlessness became paramount, leaving the focused toy retailer at a severe disadvantage. The fundamental shifts in consumer behavior were not merely about where purchases were made, but what was valued. The move towards digital entertainment, experiential gifts, and a general decline in the perceived necessity of accumulating large quantities of physical toys significantly impacted Toys R Us. The company's business model, predicated on a vast physical inventory in large format stores, was increasingly out of step with parental priorities and children's evolving interests. The toy store experience itself diminished in appeal as digital engagement and personalized experiences took precedence. Following its liquidation, attempts were made to revive the Toys R Us brand. A partial comeback saw the launch of a new online store and a limited number of smaller, more experiential physical stores in late 2019. However, this rebirth faced challenges, with physical locations eventually closing again in early 2021 as the lingering effects of the pandemic and the ongoing market shifts proved too difficult to overcome. This demonstrated that even with a leaner model and a focus on experience, the fundamental forces that led to the original collapse remained potent, illustrating the unforgiving nature of a transformed retail landscape. The story of Toys R Us serves as a stark and painful cautionary tale for the entire retail industry. It underscores the fragility of even the most dominant brands in the face of disruptive change. Its collapse highlights the critical need for financial resilience, continuous innovation, and profound adaptability. Relying on past glory or traditional models without embracing evolving consumer desires and competitive threats is a perilous strategy. The retail graveyard is littered with giants who failed to pivot, a grim reminder that every business must adapt or perish, especially in an era of rapid digital transformation. Ultimately, no single factor alone doomed Toys R Us. Its demise was a confluence of unfortunate circumstances and strategic missteps. The 2005 leveraged buyout layered an insurmountable burden of debt onto a business already grappling with the rapid rise of Amazon, the relentless price competition from big-box retailers, and an irreversible change in how families shopped, played, and valued experiences over physical possessions. These forces did not act in isolation, rather, they amplified each other, creating a perfect storm that overwhelmed even a decades-long retail institution, leading to its unavoidable collapse. The story of Toys R Us isn't just about a toy store disappearing from our high streets, it's a profound case study in the unforgiving dynamics of modern retail. It illustrates how financial decisions, competitive pressures, and evolving consumer desires can swiftly dismantle an empire, even one steeped in nostalgia and cultural prominence. Its collapse stands as a stark reminder that in an ever-changing market, innovation is not a luxury but a necessity, and even the giants can fall if they fail to adapt. The legacy of Toys R Us is one of joy and childhood memories, but also a potent lesson in business survival.